And he has this very compelling, almost rags to riches story. He grew up very middle class in Great Neck, Long Island, which was an affluent town. His family had, relatively speaking, less money than a lot of others around him. So I think from an early age, he felt a sort of hunger to become rich.
Although Cohen wasn't born into money, he had a glimpse into what money can buy. Lived in Manhattan, Cohen's grandparents were very wealthy. They often take Cohen to fancy restaurants and shows. As a child, you're very impressionable. I think Steve Cohen's grandparents' lifestyle had a huge impact on him. He saw the kind of life that money can buy. But at home, Cohen saw a sharp contrast to the living conditions of his family. Born in the summer of 1956, Cohen was the third of 8 children. In Great Neck, the Cohen family were on the low end of the financial spectrum.
How everyone in the family sort of felt that Steve would be, was special. Their mother, his brother remembered their mother cooking steak for little Steve and making hot dogs for all the other children. I mean, there was a real sense that Steve was special. He was really smart. He was going to make a lot of money. And so he was treated a little differently.
Desperate for money, and while still in high school, Steve Cohen found out a sneaky way to make extra cash. As a young man, Cohen showed an incredible talent for playing poker.
Because what poker really does is teach you how to deal with probabilities and uncertainties. And that's so integral to life. Everything we try to do, should we take this route or that route? Should I go here on vacation or there? It's all about dealing with uncertainties and probabilities of things happening. And poker is a very fun and easy way to teach someone how to do that.
Cohen would sometimes spend all night playing poker, frequently making thousands of dollars a night. Cohen realizes that there are easier ways to make money than a 9-to-5. Playing poker can sometimes make him more money than his dad. Even with the time spending on playing poker, Cohen still managed to achieve good grades, which eventually helped him get accepted to Wharton. In college, the socially rejected Cohen resorts to the only activity he finds joy, playing poker. But he soon grows dissatisfied with the money. He wants to try his hands at a bigger casino, the financial market. While still in college, Cohen accepted a job at the notorious trading firm Gruntle.
First job was at a small, not terribly well-respected brokerage firm. It was called Gruntle and Company. And it was located right close to the actual Wall Street in Lower Manhattan. It was the place where there were a lot of misfits. It wasn't sort of a slick establishment corporate environment. It was a little bit wild, and a lot of what was going on there consisted of brokers calling kind of individual investors and trying to sell them on different stock investments. But Steve was hired by a family friend who was also from Great Neck, who had started an options arbitrage desk at Gruntle.
Brand new on the job, Cohen is already confident enough in his abilities as a trader, making bold predictions about stocks. He's working for Ronald Iser, who specializes in options arbitrage. The mathematically inclined Iser was suspicious that anyone can make any predictions of a stock price, but he decided to give Cohen some money to make his first trade. To his surprise, Cohen made $4,000 in one day and another $4,000 overnight. In 1978, this was some meaningful profit. Now, Cohen is what's called an intuitive trader. Honestly, what he does is no different from gambling. He has this sense of risk and reward. It is strange, but he seemed to have this gut feeling about a stock market, and he's more often right than wrong.
Well, so people used to describe him as a tape reader, and it's a bit of a strange thing. I mean, it basically meant, before the whole trading mechanism was electronic, there was a physical ticker tape, and you could sit there and look at orders coming in and out of the market, and he was, according to people who worked with him, very, very good at this. He could sort of scan the market, he could look at all the available news and information about a particular stock, and then he could just sit there in front of his screens and make a lot of money trading, almost like what we think of as day trading now. So it it was a certain amount of natural talent and intuition.
It was obvious to Iser that Cohen is the most talented trader he has ever seen. During the mid-1980s, the American stock market was dominated by mergers and acquisitions. Cohen was making $10 million a year by building positions around events such as takeovers and IPOs. I think there's some beginner's luck to it. Just like playing poker, it doesn't matter how many hands you have won, you can lose everything in one bad bet.
Today, the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute.
When Reagan took over the presidency, American economy saw some of the biggest growth in decades. The finance industry was prospering, attracting hundreds of thousands of young men to partake in the market. Steve Cohen grew up poor, but through years of hustling, he became the star trader at a trading firm called Gruntal. During this bull market, Steve Cohen was raking more profits than anyone. But little did he know, a financial bomb is about to explode. Economic growth has slowed while inflation was still high. The strong dollar was putting pressure on exports. The valuations for stocks have gone up to excessive levels, with overall PE ratios above 20. Future estimates for earnings were lower, but stocks were unaffected. All these conditions created a perfect storm. The Black Monday stock market crash of October 1978 saw US markets fall 20% in a single day. Gruntal, along with many other firms, was practically put out of business. Cohen's group lost almost half his capital. Every one of his 7 traders was nearly wiped out by losses. We see blow-ups like this all the time. Sure, some traders might have some skills at predicting a stock, but once in a while, a market can change fundamentally. And when that happens, you lose everything.
A really great trader, what he does is he smells the fear. And what he does is he organizes himself to be able to take advantage of others' fears. Okay? And ultimately what happens there is he's disciplined. He's not acting from statistical analysis. He sees that as something, but what he's developed is an intuition of being able to see the supply and demand, and he knows the blood there and he knows where they're trapped. That's state of mind management.
As the chaos continued around him, he stayed in the game, actively trading to recoup losses. He ultimately survived the crash. But Cohen grew tired of Gruntal. He wanted to start his own shop instead. With the hedge fund structure, Cohen has the potential of making more money with less restrictions. In 1993, Cohen started SAC with around $23 million in capital and 9 employees. He put in about $10 million of his own money, and his traders and friends investors put in the rest. Although Cohen's trading strategy is hard to emulate, there are some essential principles he always follows. Taking the lessons from playing poker, Cohen believed that investing is all about smart risk-taking.
And he was very good at managing risk. He didn't get emotionally attached to his trades. He was very good about sort of pulling the plug and selling something if it just started to go against you. And, the kinds of situations where a lot of people will end up just losing more and more money because they don't want to acknowledge that they made a mistake. He was, according to everyone who worked with him at the time, he was very good at just being kind of dispassionate and analyzing risk in this very cool, detached way. And he just started to make, a lot of money, millions of dollars very quickly.
Within 3 years, SEC had quadrupled in size to almost $100 million. Cohen started buying mansions and expensive arts. He may be on top of the world, but he fails to see there's a crisis looming. The late 90s and early 2000s saw the biggest growth of hedge funds. By 2012, there were more hedge funds than public companies. Right at the top of the hedge fund kingdom was SEC, one of the most profitable shops ever. Born and raised in a middle-class family, Steve Cohen built SEC Capital from scratch, making billions in the process. The success of SEC draws admiration and envies for Wall Street, and also from places Cohen didn't expect.
Anyone working at any hedge fund who involved in short-term trading, meaning every day they're coming and trading in and out of stocks, all of those people want edge. That is a common term in the industry. They want edge. And, you know, there's this white edge that's kind of useless for their purposes. There's the gray zone, and then there's black edge, which is clearly inside information.
Since the advent of internet, information has become widely accessible, making it tougher to beat the market. Now, a great majority of the academics believe that it is impossible to ever outperform the market. Those that seem to do well are just lucky. In other words, the market is highly efficient.
Prices basically reflect all available information, so that in a strict view of the theory, it would say it's basically impossible to beat the market. You're always paying a fair price, basically.
I think there's a merit to the argument that it is virtually impossible to beat the market. I think some of these hedge fund managers know that. That is why they're looking for an information that gives them the edge. And unsurprisingly, many of them resort to insider trading. One hedge fund manager, Raj Rajaratnam, realized that as well. The only way to beat the market is through cheating.
Prosecutors want the toughest punishment possible for this man, the convicted founder of the Galleon hedge fund, Raj Rajaratnam.
In 2010, billionaire hedge fund manager Raj Rajaratnam was sentenced 15 years in jail for insider trading. But soon the prosecutors realized he is just a small fish, and there are bigger sharks to catch. By 2008, SEC managed $14 billion in equity and recovering from the housing recession and growing faster than before. In that year, SEC portfolio manager Matthew Martoma started building large positions on two pharmaceutical companies, Elon and Wyeth, who were developing promising drug trials for Alzheimer's.
There were several analysts and traders who felt very bearish on Elon and Wyeth. And they could not understand why Martoma and Cohen were building up these pretty substantial unhedged positions. And Cohen would say, well, Martoma knows a lot about this.
It turned out Martoma's information came from a special source, Dr. Sidney Gilman, who was affiliated with the company. The two drug companies were scheduled to announce the final results of the trial on July 28, 2008 in Chicago. But through Dr. Sidney Gilman, Martoma knew the trial was a disappointment. SEC started to aggressively unwind its large positions in Elon and Wyeth, and in fact, ended up going short those two stocks to make bet against them. The share price fell through a cliff. In the meantime, Cohen made $276 million betting against the two companies. While enjoying this incredible profit, Steve Cohen did not realize that this is the beginning of his downfall. Martoma was convicted in 2014 as what federal prosecutor claimed as the most profitable insider trading conspiracy in history. At the same time, the SEC brought charges against a number of other SEC employees. Before long, Cohen himself was charged by the SEC for his failure to supervise his employees. Cohen settled his civil case with the regulators in January 2016 and was banned from managing outside money until 2018. Fortunately to Cohen, with the help of his team of prestigious lawyers, Cohen himself was able to avoid any criminal indictment. This is a devastating blow, but Cohen refuses to give up. He now must look for a new edge, one that allows him to continue to make great profits. By 2014, SAC closed its door and converted to 0.72, a family office.
And so the ability to have your own family office controlling your investments, controlling your cash flow without every other big firm knowing about it is very important. And I think that's a lot of the reason you're seeing more and more of them start up.
Essentially, Cohen gets to run his hedge funds made out of his own money. He also realizes that he could stake other hedge funds run by his former employees. Majority of the return is from the investment at Melvin Capital that made 47% in 2020. Without the black edge enabled by insider trading, 0.72 has not been able to make large returns like what SAC used to. Its only hope is allocating his money to other hedge funds who may possess the black edge. Known for his audacious bets and crazy returns, Gabe Plotkin was a superstar portfolio manager at SEC.
With Mr. Plotkin, it seems like really strong stock picking. He's had experience managing money for a long period of time. He was at SAC and then 0.72 since 2006.
Gabe Plotkin has been consistently outperforming the market over the past years, reminiscent of OG Steve Cohen. But neither Cohen nor Plotkin could anticipate a group of amateur traders from Reddit will bring them down to their knees. Hedge funds are raking billions for their wealthy investors. At the forefront of this growth was Steve Cohen, who single-handedly turned a small-time fund into a $50 billion empire, almost doubling every year. It turned out his secret was insider trading. After being dismantled by the authorities, Steve Cohen is forced to think of new ways to make money. 0.72, the new firm Cohen founded, started to make high returns after allocating to other hedge funds started by his students. 0.72 was regaining its past glory, but Cohen's newfound success will soon be challenged by the most unlikely group of people. On January 22, 2021, approximately 140% GameStop public shares have been sold short. With such a large amount of shares being shorted, they could trigger a short squeeze.
That the stock market will be brought down by the wild actions in stocks like GameStop. That's that retailer place game. You go in and you buy video games, you buy the hardware. This GameStop is really something we must talk about because it's been bid up higher and higher by enthusiastic traders.
By the end of January 2021, Melvin Capital had a loss of 53% of its investments. Now struggling for life, Cohen partnered up with the Citadel, putting $2.75 billion to bail out Melvin Capital. Both hedge funds lost a lot of money during this incident. It was like the Hightower surprise to all hedge funds. It is safe to say that 0.72 has lost its edge. Recent years, Cohen has expanded his investment into venture capital, quant strategies, and so on. This is all in search for new alpha. But with the regulators constantly watching them and the negative public sentiment against hedge funds, Cohen has essentially retired from the active role.
Follow your passion. It's not all about money, right? The money comes from, success comes from being passionate about something and then doing it to the best of your ability, whatever it is.